FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to and maybe even watching the Financial Survival Network. And if you're watching the show, you kind of understand the situation that the markets are in, that the global economy is in, that what's going on with unemployment, shutdowns from the pandemic, and other things. But what do you do about it? You know, we like to talk about solutions on this show, how you prosper regardless whether the odds are against you or whether the markets or the economy is against you. That doesn't mean you have to give up and not earn a good return and give up any thoughts about retirement, or as I like to call it, semi-retirement, because baby boomers just don't retire. They kind of like go to the grave with their boots on, so to speak. And got somebody good here, trader, written a book and written a number of trading courses. And it's my pleasure. First, hey, I want to get your opinion where you see things are heading in the economy, in the market. And all you got to do is email me, kl@kerrylutz.com, kl@kerrylutz.com. So right now I have Michelle Schneider with me. And Michelle, you've written a book, Plant Your Money Tree, A Guide to Growing Your Wealth. Now, obviously, you wrote the book a while back. Things have changed somewhat, but what do you think has stayed the same over the past year since the book came out?
Well, the market in general is not a compassionate entity, and yet it follows the path of least resistance, and that is something that has not changed and will never change. So really, our job as traders is to kind of follow the money. And what the book covers is a series of 6 different phases. And those phases act as a navigation system. So in essence, if you wanted to follow the money, whether you were a perma-bull or a perma-bear or incredibly open-minded, which obviously is the best way to be, you can learn how to follow these phases and then be able to make money on the basis of when these phases change, as that's usually a really good inflection point.
Yeah. So when you talk about a trader, different people perceive the profession of trader differently. How do you define being a trader, Michelle?
Well, for me, it's changed. I've evolved. When I first started in the business, when I first started in any business, I was a special education teacher in New York City. And so finance was not something that was even on my mind. I grew up in a low middle class family, which we did not discuss the stock market at dinner. And then I, by circumstance, met this girl who worked on the floor for Merrill Lynch on the commodities exchange. She brought me down there and I just went nuts. I said, oh my God, this is where I need to be. And I managed to get a job for Continental Grain Futures Division, Conti Commodities.
Oh, yeah.
Yeah. So, I started out, there were very few women, obviously, but it was also an incredible time to be on the floor because it was when stagflation, hyperinflation was happening. And so gold, silver, food commodities, sugar were all going berserk. So my mindset was real. I learned everything I needed to know about trading down there, especially your own market psychology in terms of the foibles. People tend to overdo things, and I learned that firsthand. But as I've evolved, I'm now an upstairs trader and have been for the last 13, 14 years. And so I still hear the floor in the sense, the 5 senses that engage, but I use, as I was saying, the phases and a bunch of other tools that we have to really help me time my way in. And I'm looking more, not for the quick swing, day trade or scalp, but I'm looking more now for trades that last anywhere from a week to several months to potentially several years.
Yeah, understand where you're coming from. So the markets have changed a lot since you first got involved here, because back then, trades actually got executed on the floor. You had these specialists that provided stability to the market and liquidity. Being a specialist was just a license to print money back in the good old days. And the better the stocks you were specializing in, the more money you made. Now, Wall and Broad Street, it's kind of a screen set, a stage setting. Nothing really happens there. Very little of the trading takes place. And Emperor has no clothes. We saw during the pandemic that they shut it down and nobody seemed to have noticed. But in the specialists, you could call them opportunists, they did play a very important function. They kind of had a oligopoly or a monopoly on their stocks. But now you got these high frequency traders, the algorithms, you got all these different forces that are literally arrayed against the individual investor or trader. How do you still make money when the odds seem to be so overwhelmingly stacked against you?
Well, you make some really good points, but if I thought like that, then I would change careers. So I've had to find the more positive avenues to make money. And there are quite a few. Now, of course, we're talking about a completely different world right now because probably the biggest bolster of the market has been the central banks and the Federal Reserve. And that is, to use a word that's so overused, unprecedented. But but yet the simplicity of that is, the old "don't fight the Fed" has certainly been the case. And with all the bad news that has come out over the last several months after the initial swoon when the market was caught off guard, now the market has shaken all of that off because it believes that the central banks will keep things going. That's number one. And number two, you have another new phenomenon, something that I've never seen before in my life, and that is a host of young traders coming in, these Robinhood traders.
The Robinhood effect, I call it.
The Robinhood effect. But you know what? They're up 24% versus institutional investors that are down 8%. So isn't that interesting?
I call them Epstein economics. Feels really good while it's going on, but eventually you're going to pay the piper. And, they already found one guy killed himself because he thought he had lost $750,000 on his account, but it was hedged. But the format of the reports on Robinhood didn't really explain to him that he wasn't nearly $1 million in the hole, but without getting too much into that. So, yeah, the Robinhood guys, they were buying up Hertz Rent-A-Car in bankruptcy. You and I know, you don't buy a bankrupt company's shares. If you think it's a good investment, you buy its debt. But they were clueless and they drove it from 50 cents up to $6 to the point where Hertz was even going to do a share offering, even though they were going to be selling shares into the market that would eventually become worthless after the Chapter 11 plan was executed. And finally, for once, the SEC actually stepped in and said, no mas. But, can you allow the Robinhood tail to wag the dog here? Is that a good thing?
Well, again, let's go back to where I got started, because this isn't so dissimilar to what happened to many, many traders in the commodities days when everything was flying up. Money was so easy. And what really separates, and I'll say the men from the boys, I'd like to throw some women in there as well, is knowing and understanding certain concepts that you have to have as a trader. Number one is not buying a falling knife. Number two is understanding the concept of a stop loss. And number three is, we're not in the storage business, we're in the moving business is the great expression. Instead of thinking of things as passively investing, understanding that when you're getting a parabolic move, it's okay to take some profit. And so, these Robinhood traders sort of remind me of the young traders I was one, where it looked so easy. And then the people who didn't learn their lesson or kept buying as things were going down, knowing that things were just going to reverse, I just know it. Those are the ones that were carried out. So the lessons, as you say, everything's changed, but certain concepts never change. And hope, fear, and greed, those are three emotions that never change about human nature.
Yeah, well, kind of greed and hope kind of go hand in hand together. But yeah, agreed. Human nature is a constant throughout humanity, throughout human history. And of course, the one thing we learn from history is that we don't learn from history. Exactly. And right. So, these Robinhood, they're all like lemmings going off a cliff. It's really easy for the pros to lead them down the garden path to the guillotine, isn't it?
Well, I'm sure there'll be plenty of people who get their heads chopped off, and I hope that doesn't happen. But I also think that just like natural attrition of anything, like on the floor, there'll be plenty of people who will actually be smart enough to know that they ran the move and they got the most of it and they get out and they hopefully have some patience. And I'm sure they'll be hunting for the next big move. One of my biggest concerns here is what's happening with clean energy and Tesla. My goodness, I mean, Tesla's just been insane. And my concern is that, these are all well and good, and one has to hope that clean energy, electric cars, that's very forward thinking and will probably become more and more popular and mainstream as the generations that are younger get older and us baby boomers, go on. But we're still an oil and gas economy. And that's really what concerns me, is that it's wonderful to make these investments and see the stock go up. But we know that at some point that disconnect between what's happening in the economy and what's happening in investments comes home to roost. So I think we'll be able to really see now whether these young people who are having fun making money in the market turn this into action that creates jobs and industry in the areas that they want to be socially conscious in.
Yeah, Tesla is a great example. Talk about falling knives. And, I've been a car person my whole life. I've owned over 60 cars in the past 40-something years. And besides not being a good investment, unless you're buying classics, and even those are dangerous, point is, right now, there's 1.3 or 4 billion cars on the road globally, and we add and these are light trucks and cars, and we sell roughly 80 million new vehicles per year into that market, of which a very minute percentage are e-cars, electric vehicles, a lot of hybrids in there, probably another 5-10%. For electrics to prevail here, we got to see a massive increase in production, because even if we switched to producing all electric vehicles tomorrow, Michelle, so we're producing 80 million a year, that would still be nearly 20 years of production to get the last gasoline powered car off the roads. And even if this dream of autonomous driving comes through and people don't really need to own cars because they just hail a autonomous Tesla and it takes them to heaven. Even if that comes true, you're still going to have to replace upwards of 1 billion vehicles. And I won't even get into the supply chain for all this stuff, because that's evolving. I'm sure those problems will be solved. But so maybe our drive towards clean energy is a little bit misguided or overly optimistic?
I'd like to say overly optimistic, given a choice of the two. I try to stay positive because it helps your mindset as an investor. I've seen so much cynicism, particularly in the last few weeks, and it's completely merited. I understand it from a theoretical standpoint. But from a practical standpoint, as you said, people think this is a tough time to make money. Well, we've had actually a pretty great year. And part of the reason is because we've been following some of these NASDAQ stocks. We have quant models that we put our clients in that have followed the top NASDAQ stocks, including Tesla. And also because we also, as commodity traders, all of us, my husband, who is the CEO of the company, and our other partner in New Jersey, we all were on the floor. We've bought gold and silver, and 35% of our portfolio right now is in gold.
Yeah.
So that's the other thing is, going back to your point about these kids and not really understanding, at this point, it's a risk off and a risk on environment, and the Fed has helped it stay off the risk on thing too much, or the risk off thing too much, I should say. And so it's giving a false perception. I actually believe that some of the fallout of this is going to be a sort of a stagflationary environment, where these high-flying stocks will have to come off. Maybe we'll get some sectors that'll get a little bit better that have really underperformed, but the traditional energy sector, I'm not sure. We're going to have a lot of earnings coming up, and the prediction is for 150% loss in earnings in energy. So what I'm looking at is obviously not an oil-fueled inflation because oil is so cheap, but maybe what gold is telling us is this burgeoning money supply and the fact that things are so artificially propped is reasons to be concerned and look at commodities, because people will hoard what they need versus, buying Teslas and new iPhones.
Well, you're kind of preaching to the choir here. When I started this show, it was in 2010 and 2011. We had just had the Great Recession. We were getting a very slow recovery, and precious metals were booming. Then they peaked in 11. Then they had sideways to down. Silver went down. It was close to $50 an ounce, and went down as low as like in single digits, $8 or $9 a couple of times. And even in March, when we had the crash, silver was down around $12. Now it's rebounded. It's trading at 19 something.
Right.
And gold took a hit too, but it was interesting compared to 08 and 09 when that crash occurred. Silver and gold rebounded way, way faster. And what message is that flashing to you, Michelle?
Well, as I said, I think the message is that people, as much as they're having fun buying some of the high-flying stocks, they're nervous about the overall market, the overall economy. And it's not necessarily because of COVID. That was sort of a straw on the camel's back. But economically, we haven't really done all that great in quite some time. Our GDP was sort of struggling along 3.4, 3.5%. The numbers now, of course, are all skewed because of the virus. And I also think we're going through this sort of deglobalization that's happening throughout the world. And that can be inflationary, because when countries are forced not to trade or discouraged from trading with other countries, and they're looking to themselves, then you get that hoarding mentality of raw materials. Gold's reflecting all of that, reflecting the fear of the Fed, reflecting some geopolitical concerns, reflecting our upcoming election, which could be extremely volatile. As we know, we've had a lot of social unrest already. What's going to happen as we get closer to the election and what happens as a result of the election. These are times that nobody can sit on their laurels and just say, here we go, like right after 2008, when you were talking 2010, 2011, it was pretty obvious that we were going to start to recover slowly, but surely. Now it's hard to say. We have a lot of deregulation, so it's a little bit, it's exciting as a trader if you're on the right side, but this is really where you have to understand risk management very, very clearly and have a plan. And if you have your money in retirement accounts, which we all do, I think you have to really what's one thing if you're getting ready to retire, but if you're still 20 years away from retirement, you probably want to pay a little bit of attention to what happens over the next 6 months, because it can affect your retirement money for the next 5 to 10, 15 years.
Yeah, for sure. Could not agree with you more. And yeah, I think it was Eisenhower said things are more like they are now than they ever were before. And certainly we're in that type of situation where, the passive investing trend, just buy a bunch of ETFs, put them in the account and go back to your day job and just let them make 25, 30% a year. Obviously, that's not going to cut it anymore. And so how do you, when you're looking for the ideal investment mix, if you will, what are you looking for? Are you looking at sectors? Are you looking at individual stocks, top down, bottom up? Are you mostly technical, or do you look at fundamentals?
FSN Radio. It's all about what's next.
Lumina Gold, ticker symbol LUM on the Toronto Venture and LMGDF on the OTC, is yet another of legendary mining investor Ross Beaty's Lumina Group. It's advancing the largest primary gold deposit in Ecuador. The resource is estimated to contain 16.7 million ounces of gold and 2.2 billion pounds of copper. At just $7 US per ounce gold equivalent, it trades at an incredible 13% of its net present value. More good news is on the way with an updated PEA study expected in Q2 of 2020. It has unparalleled infrastructure. There's grid power to camp with plentiful, inexpensive hydropower available. It's close to 2 ports and is just 8 kilometers from a paved highway. Water is plentiful. It's at low elevation, and the closest community, which is very supportive of Lumina's effort, is just a 7-kilometer ride. With all this going for it, it's likely to follow the typical Ross Beatty formula, which means big returns to shareholders. Find out more and sign up for notifications at luminagold.com. That's Lumina, Lumina gold.com.
The Financial Survival Network. It's all about what's next.
I actually sort of have a 3-prong, if I had to make it really just succinct approach. Number one is I do look at megatrends. So I'm very interested in whether it's a social trend like social media, or it's a clean energy trend, or it's a potential cannabis trend, because that could be something that comes on the scene over the next year or so, depending on many factors, one of which would be the election, or whether it's geopolitical unrest trend. Whatever the trends are, I'm very interested in. And so that's the first thing I will keep my mind on, because that's where I'll get my ideas from. Then the second thing is I created something, this is what my second book is called The Economic Modern Family. So essentially what I do for a macro viewpoint, which helps with a fundamental viewpoint, is I look at the Russell 2000, the small caps, as the premier index for me, because that's 2,000 stocks manufacturing mainly in the United States. So that's going to give you a really good picture of what's happening, the true picture, which is why the Russell 2000 is lagging so far behind NASDAQ. And then there are 5 sectors that are in there, which give us a good picture, one of which is the retail sector, and not just e-commerce, but brick and mortar. One is transportation, which would be like the demand side of the Russell supply side. And then I also look at regional banks, as opposed to the big banks, because that's really where you see these loan delinquencies happen. And then semiconductors, which of course have been amazing and a part of the economy, but not the whole economy. And then finally, I also look at biotech and biopharma, which was lagging up until this COVID situation and now has started to outperform. And when I look at all of that, that really helps. And then the third thing is what we were talking about right in the beginning, which is then I look to see what phases they're in. If it's a bullish phase, a bearish phase, or what I have these in-between phases, and that tells me whether or not I should be aggressive, and then how much I should take on, how much risk, et cetera, how patient I should be to watch if they actually can make money.
Right. Okay. So you kind of combine the two, right? But will you buy a stock even if its fundamentals don't look good, if its chart pattern looks good?
Yes, absolutely. I am a chartist first. When I was on the floor, part of the reason that I became a great chartist was because physically, when the pits would get insane, that was not a best time for me because I wasn't physically as strong or loud enough to compete with the guys. Yeah. So I would have to step out and I would chart. And then I would be able to step in and put my order in and step out or give my order to somebody else. And so I am very much into charts. And we have indicators that we have created. They're called real motion indicators. So they'll show a divergence that the momentum in something is improving, even if the price isn't. So we work for the confirmation. Perfect example. Cannabis. Let's talk about cannabis. And this is, again, totally apolitical, just a mega trend. Obviously, with so many states that have already had medicinal marijuana legalization and recreational marijuana, and it looks like we're going in that direction, especially as you say, study history, but yet not learn from history. Prohibition ended. The charts right now were underperforming, but the momentum was starting to increase. So we got long CGC, which is cannabis growth. I've been telling people to get long MJ, which is the ETF for marijuana. And of course, you have to have a stop. Again, you don't want to get killed on it. It can always go down. But so far, since we got in, which was just about a week ago, MJ alone was up like 3% when I looked at it earlier today.
Yeah, I know the cannabis trend. I said when the Great Recession hit, I said within 5 to 10 years, cannabis will be legal throughout the country. I'm a little bit behind the curve for obvious reasons, but just looking at the Great Depression, that put the end to prohibition. And that's what I was expecting to see a replay of here. But the problem with the stocks is, in my opinion, and like I say, I'm kind of market agnostic, but a number of cannabis companies have sponsored my show. And, the stuff might not grow on trees, but it grows on stalks like corn. And therefore, if you assume that it's been illegal since basically the Great Depression, because they needed a replacement to give all those federal enforcement officers something else to do when prohibition ended, so they banned drugs. When you actually look, you see that all of the illegal demand, all the demand was being satisfied illegally. So that means that the legal producers are going to compete against the illegal producers to satisfy a market that maybe it's a growth market. I'm not talking about medical. I'm just talking recreational. Maybe it is, maybe it isn't. I've heard a lot of claims for cannabis type products that will cure everything from the common cold to, I don't know what, to Alzheimer's. I mean, ridiculous claims that I've seen no science support. So in the long run, when, you're competing against an illegal marketplace, you're kind of relying on enforcement to get rid of your competition. How is that going to work?
Well, I have to say, as most intelligent people do, which obviously, Kerry, you are highly intelligent, you tend to overthink. Because a lot of times you can't possibly predict what's going to happen, which is why they say price rules. And I say they, traders, say price rules. And so everything you say could be absolutely on the money correct or not. We don't know. And, and you can look at almost anything and make a case positive and make a case negative. So, it's like any decision you make in life. You weigh the pros, you weigh the cons, but ultimately you make the best decision for yourself because you think that the reward outweighs the risk. And so I'm just going to say, leave it at that. As far as I'm concerned, I'm ready to be wrong. In fact, every trade I approach that way. I'm ready to be wrong. This is when I know I'm wrong, and this is where I cut my loss. But at the same time, it doesn't prevent me from anticipating that when I'm right, I could be really, really right, and that will far make up for any of the small losses I've taken along the way probing. And that's what we're doing with cannabis right now. I could be ahead of myself, but right now we're making money. At this point, we're making enough money where we can probably at least put what we call a no-loss stop. So if it goes back down, nothing lost, nothing gained. And if it keeps going, we'll have a profit target and we'll see from there. That's all that anybody can do. None of us have crystal balls, but we do have at least probability.
Yeah. Well, my concern about cannabis, and I'm not questioning your conclusions at all. It's a trendy thing. It's a sexy segment of the market, and it definitely attracts a questionable brand of stock promoters to it. And you saw a lot of people get burned and flushed out of the market. Now, if that was the plan,
Oh my God. Yeah. You remember then about 2 years ago, cannabis was going crazy, and actually it's been sitting kind of near all-time lows. And, unlike Warren Buffett, I don't have his I don't have his deep pockets, but like Warren Buffett, I definitely get interested when something seems like it's of value to me. So I have to time my way in much better. Here's another classic example. He just got involved with Dominion in the natural gas. So let's talk about old school for a second. I'm an old oil trader. I spent most of my years in the Merc after I started out in coffee, sugar, and cocoa. And I just bought natural gas, the ETF, again, UNG, with my clients. I did it before, actually, Warren Buffett came out with that announcement. But I did it. The news is terrible. It was at all-time lows. But it had an interesting technical pattern that I found compelling, which is what we call an island bottom, where something gaps to new lows and then gaps up and leaves literally like an island, if you imagine water around that price action. So it gives you a very clean risk to see if natural gas will go up from here. If I can't think about it more than that, other than manage the trade and see what happens.
That's funny. I remember the clock on the International Cocoa Exchange. It was a very unique clock.
Yes. Wow. Yes.
Yeah. I don't even know if it's there anymore or not.
I don't know.
There. I think it's an apartment building now, the Cocoa Exchange. Last time I looked, as I spent a lot of my life in Lower Manhattan. So rules, 3 top rules for investors not to get ruined in the current market environment.
Well, I think one is to basically diversify your assets, which, most people have heard the term that may not necessarily know what that means. So let's put it very simply. I wouldn't necessarily say what's always safe will continue to be safe. Bonds have been safe. That doesn't mean they're going to stay safe. So I might have a little exposure to bonds, but I wouldn't overdo it. Obviously, if you're not in the gold and silver markets right now, it doesn't mean it's too late. You just have to play it a little bit shorter term than if you got in, when it crashed back in March. I also believe that the ratio of commodities, and I'm talking about food commodities, to equities is at a 100-year low, going back a la Buffett. That means that ratio is so ridiculously out of whack. At some point, when do food commodities start to come back? So we're looking at that. And we're playing some of the tech. We're looking for the next Apple, not necessarily Apple. So we're looking at some of these emerging companies that are coming up that are small cap growth stocks, especially those that are good for our new world order, which is basically going to be keeping a social distance and working at home. And then, I would continue to have, there's some stocks are actually paying more dividend than bonds are paying yield right now. That could be the sign of a bubble, but who knows when a bubble happens. So I'd say the most important thing is to not let whatever you have in your portfolios get killed, thinking that the downturn will come right back. Because in 1969 to 1982, 15 years, the market stagnated. We had a lot going on during that time. And it wasn't until Volcker started raising the rates in 83 when the economy improved. We could go through a period. So I would just say people should be aware and at least question anybody who might be in control of their money, or if they're in control of their money, get a little bit of an education on what it means if things start to roll over for their money. Yeah.
Well, I think that's sound advice. And besides your book, Plant Your Money Tree, A Guide to Growing Your Wealth, what publications you think are must reads, either daily, weekly, monthly, whatever?
Well, Mark Minervini, I think I'm saying his name correct. I hope I am. He's written quite a lot of books. Those are more for people who are actually wanting to invest. I think if you really wanted to understand about position sizing and risk management, Van Tharp is the master of that. He's written a lot of books. These are some of the books that I have read. My book is actually rather unique. Not that I'm trying to give it a ridiculous
you can
plug.
give it a plug. It's all right.
The thing is that I was a special ed teacher. Remember, I told you I was a special education teacher in the beginning. So what I did was I wrote a book that wasn't intimidating like a lot of these technical books where a mainstream audience will look at it and go, forget it, I couldn't even get past the first paragraph. And it's not condescending like a lot of these wealth books that basically say, passive invest, never worry, save your money, live below your means, et cetera, like some people that are out there. This was really meant to be right in the middle, where you could understand it. It's in a conversational tone. It tells you about this navigation system. I give you a lot of personal anecdotes about my experience and other people's experience. So that's why I wrote the book, because I don't think there's anything else really out there like it.
Okay, well, we have a link in the show notes to your Amazon listing for your book there. We appreciate you coming on. Any questions or comments from Michelle or myself, please email me, kl@kerrylutz.com. And Michelle, what your website? Just tell us what your website is.
So my website is marketgauge, GAUGE.com. And if anybody wants to talk to me directly, I'm very active on Twitter. And that's the best way to reach me. And that's @MarketMinute. That's my handle.
@MarketMinute. All right, we got that. We really do appreciate you taking time out from your busy trading day to help educate us. And I'm sure we'll have you back on again, especially if anything crazy goes on in the market, because it sounds like you have a very level-headed, pragmatic approach to not losing money, which kind of has to be your first priority. when you're investing in anything. And we appreciate you coming on. Like I said, any questions? Yeah, any questions or comments, just email us, kl@kerrylutz.com.
Thank you so much. It was such a pleasure to be with you today.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.